You finally get a buyer, the chain looks steady, and for the first time in months, you let yourself breathe. Then the solicitor sends the figures over, and the number you thought was yours starts shrinking line by line. A tax here, a fee there, a second bill you did not even know could land on your doormat. And suddenly, the move that was meant to make retirement simpler feels oddly expensive and strangely rushed. If you like calm, plain English videos that help you stay one step ahead of the rules, do subscribe and keep a seat here. I try to talk about the things ordinary people are often told far too late, and house moves in later life are one of them. Not because moving is always wrong, but because the small print can bite when you are living on pension money and careful plans. And if that sounds like your kind of conversation, you are very welcome to stay with me. So when I say never sell your home in retirement, I do not mean nobody should ever move. I mean never sell first and do the maths later, because a house sale in retirement is not just a property decision. It is a tax decision, a timing decision, a paperwork decision, and sometimes a family decision all at once. That is the central theme today, and I want to walk you through 6 simple ways that truth shows up. First, the price on the estate agent's board is not the money that lands in your life. A lot of people sit at the kitchen table, hear a lovely valuation, and quietly start spending the difference in their head. They picture the smaller place, a bit left over, maybe a holiday, maybe a cushion for rising bills. But the real figure only appears after selling costs, buying costs, tax, and all the overlap in the middle. In England and Northern Ireland, the stamp duty rules changed again from April 1st, 2025, and that matters to ordinary movers. For a main home, the nil rate band went back to £125,000, then 2% applies on the next band and 5% above that band. So even if you are buying a smaller place, the tax on the new home may be more than you expected if you were using older figures. And if you live in Scotland or Wales, the tax has a different name and different rates, but the lesson is exactly the same. Write this phrase down and keep it near you. Sale price is not spendable cash. The safer number is this one: sale price minus mortgage, minus estate agent, minus solicitor, minus removals, minus buying tax, minus fixing up costs. That is the number worth planning with, because retirement money has to last, and guessing is far too expensive now. The central theme comes back here at once, because a move is never just about what your old place sells for. If this kind of plain talking helps you slow down before a costly mistake, you may want to subscribe and keep these reminders close. The people who usually stay safest are not the cleverest people in the room, but the ones who force the numbers into daylight. That is why the first point matters so much, because it turns a shiny property conversation back into a real-life money conversation. And that is often the moment a rushed move starts to calm down. Second, a lot of retirees get caught not by the sale itself, but by the timing of the sale and purchase. They buy the next place before the old one has fully gone through, or the chain wobbles, or completion dates slide apart. On paper, it feels temporary, just a few weeks of overlap, but tax rules do not care how temporary your stress feels. They care how many properties you own on the day the new purchase completes. If buying the new home means you own more than one residential property at completion, the higher stamp duty rates can apply. From April 1st, 2025, that extra charge is usually 5% on top of the normal residential rates in England and Northern Ireland. Many people hear the word temporary and assume the bill will be small, but on an ordinary home it can run into many thousands very quickly. And the really painful part is that this often arrives when you are already paying movers, legal fees, and 2 sets of household bills. There is a relief to remember here, and it is worth saying slowly: the 3-year reclaim rule. If the new place is replacing your main home, and you sell the old main home within 3 years, you can usually apply for a refund of the higher rate part. But that refund is not magic money that arrives by wishful thinking, and there are deadlines and details attached to the claim. Your stamp duty return and payment are due within 14 days of completion, usually handled by your solicitor, but still your responsibility in the end. Janet is a good example of how this goes wrong without anybody being reckless, and Janet is 68, widowed, and tired of stairs. She found a neat bungalow near her daughter, paid for it before her old house sold, and thought the overlap would only be a short bridge. Then the buyer below her pulled out, the sale dragged on, and Janet suddenly had a higher tax bill. 2 utility accounts, 2 council tax worries, and very poor sleep. If you would like more of these quiet warnings before they turn into expensive surprises, subscribing might save you more than one nasty letter. Third, do not assume the sale of a home is always free of capital gains tax just because you lived there once. For many people, yes, the main home is protected, and that is exactly why this catches people off guard when their case is not quite standard. Perhaps they rented part of it out for years, perhaps they used a room only for business, perhaps they moved out long ago and kept it. Small differences in how a home was used can change what feels like a simple sale into a tax question. The usual main home protection works where you had one home, lived in it as your main home the whole time, did not let part of it out apart from a lodger, did not use part of it only for business, and did not buy it simply to make a gain. If those points fit you, there is often no capital gains tax on the sale of that home, which is a real relief. But once the facts drift away from that picture, the answer can change, especially for people who have had a rental period, a long absence, or more than one property. And married couples and civil partners need to remember only one property can count as the main home at any one time. So here is the phrase to remember: pass the main home test before you count the money. If capital gains tax is due on a property sale, the reporting clock can be much faster than people expect, because tax on most UK property gains has to be reported and paid within 60 days. That catches older sellers who are used to thinking everything just gets sorted at the end of the tax year. And again, our central theme comes back, because moving house later in life is also a paperwork race, not just a bricks and mortar decision. If these are the sorts of details you wish somebody had explained to your parents, your brother, or even to you 10 years ago, this channel may be worth keeping. I do not believe in frightening people, but I do believe in naming the trap before somebody steps in it. The simple truth is that retirement moves often look easy from the outside because the house has value. The part people miss is that value and usable money are not always the same thing. Fourth, selling or downsizing can affect inheritance planning, and this is where many families get muddled. A parent says, quite reasonably, I will sell the big place, bank the cash, and the children will be better off later. That may still work perfectly well, but the tax position now depends much more on what is left, who inherits it, and what the paperwork says. In other words, once you swap bricks for cash, you need to check the family plan still lines up with the rules. There is an important protection here called the Downsizing Edition, and many people have never heard the name even though it can matter a great deal. In plain English, if somebody sold, gave away, or downsized from a home on or after July 8, 2015, their estate may still keep the residence nil rate band if the conditions are met. The broad idea is simple enough. You should not automatically lose that home-related inheritance tax allowance just because you moved somewhere smaller or sold up. But the old home would have needed to qualify, and at least some of the estate must pass to direct descendants such as children or grandchildren. The phrase I want you to keep is this one: downsizing does not automatically destroy the family allowance, but the family line must stay clear. If the will is out of date, if the assets are left in a different way, or if nobody checks how the estate is structured, a family can miss protection they might have kept. This is one of those areas where people think selling the property makes life simpler, when in fact it may make the final paperwork more important. And that fits our central theme exactly, because the move only looks simple until the rules around it start joining up. So before anyone says, sell now and sort the rest later, please pause and look at the estate side as well as the moving side. A smaller home can absolutely be the right choice, and so can renting, and so can staying put. But any plan that touches inheritance, children, grandchildren, or a second marriage needs one extra level of care after the sale. If you value calm explanations that help families avoid avoidable losses, you are very welcome to subscribe and stay with me here. Fifth, never confuse a house sale with a care fees escape plan, because councils look closely at intention. This usually comes up in worried conversations at the worst possible time, when someone is frail or a partner has died, or the family is scared by stories about care homes. A son or daughter says, why not put the money in my name, or give the house away now, or move assets before anyone asks questions? That may sound practical in the moment, but it can create a much bigger problem later. The rule many people need to hear is called deprivation of assets, which means deliberately reducing money, property, or income so it will not count in a care fees assessment. If a council decides that avoiding care costs was a significant reason for what you did, they may still assess you as if you still had the asset. Giving away a lump sum, transferring title deeds, spending unusually large amounts, putting assets into certain structures, all of that can be looked at. Timing matters as well, because they may ask whether you could reasonably have expected to need care and support when the assets were moved. Malcolm, who is 74, sold his house after a fall and felt panicked by every story he had heard about losing everything to care. He gave a very large sum to his daughter, told himself he was simply helping family early, and felt brief relief until the local authority later asked why the money had gone. What hurt most was not only the paperwork, but the strain inside the family, because what felt like protection at the start became suspicion and stress later on. This is why I say a house sale in retirement is not just about money coming in, but about what that money is meant to do next. The phrase to remember here is the care fees intention test. If a move or a gift is truly about lifestyle, safety, grief, health, or being near family, that may be one thing, but if avoiding future care charges is a major driver, pause. Get proper advice before moving money around, because once a plan is built on fear, it is very easy to make a decision that solves nothing. And if you think more people deserve calm guidance before the panic sets in, you might find it worth subscribing for future conversations like this. Sixth, even after the sale is agreed, the money itself can create a fresh set of risks. Large transfers trigger checks, solicitors will ask where money has come from, banks may question unusual payments, and none of that means you have done anything wrong. It is part of anti-money laundering rules, which are meant to stop criminal money being washed through ordinary transactions. But for older sellers, especially those not used to moving large sums online, it can feel intrusive and unsettling. So, let me give you a very practical phrase here. Clean money still needs a clean trail. Keep documents, keep statements, keep sale paperwork, and do not be offended if your solicitor or bank asks questions, because they are expected to follow the source of funds. At the same time, be very wary of emails or calls claiming bank details have changed at the last minute, because money transfer scams thrive in the fog of a house move. If anybody tells you to send funds to a new account, stop, use a trusted phone number you already hold, and verify it the old-fashioned way. There is one more sting in the tail that catches retirees who move out before the old place is sold. In England, councils can charge extra council tax on empty homes, and from April 2024, the empty home premium can bite after 1 year empty rather than 2. From April 2025, councils can also use powers to charge up to a 100% premium on second homes, though exceptions may apply in some cases, including limited periods where a property is being marketed. That means your half-finished move can become a tax leak from both ends, which is why I call this the empty home clock. So the summary for point 6 is simple enough to remember in one breath. Protect the transfer, respect the checks, and watch the empty home clock before a delayed sale starts costing you month after month. A house move in retirement is not finished when the boxes arrive, because the financial risks often carry on after the front door closes behind you. If this kind of steady warning helps you think more clearly, do stay with me by subscribing when you feel ready. Now let me bring all 6 points together in the most practical way I can. Before you sell, sit down with one sheet of paper and write 5 honest answers. What will the next place really cost? What tax could arise? What happens if the dates do not line up? How does this affect the will? And where will the money sit on day 1? Then add one final question, and it may be the most important one of all. Am I moving towards something better, or am I moving away from panic? That little pause can save more money than any clever trick, because panic is expensive and paperwork is patient. And if you know one person who needs this, do them a kindness and send it on quietly. A sister thinking of downsizing, a neighbor struggling with stairs, a widowed friend, an older parent, a brother who thinks the sale price is the same as usable cash. Not to alarm them and not to start an argument, but simply to help them ask better questions before they sign anything. Sometimes the kindest financial help is not lending money at all, but helping someone slow down before a bad move. The central theme has been the same from start to finish, and it is worth hearing one last time. Selling a home in retirement is not wrong, But selling without a full map of the taxes, timings, checks, and family consequences is where the harm begins. The move itself may last a few weeks, but the money decisions tied to it can shape years of retirement afterwards. That is why the safest move is so often the slower move, the better costed move, and the better documented move. I think of it like stepping from one boat to another at a quiet harbour in the early evening. You do not leap just because somebody on the shore says the tide looks fine, and you do not move because the other boat seems smaller and cheaper. You put one hand on the rail, you check where your feet are going, and you wait until both sides are steady. That is not fear, and it is not delay for the sake of delay, but simple dignity with your future still in mind. Your home is not just an asset, and your retirement is not a race. Take the time to see the whole crossing before you step. That calm, careful pause is often what protects the money, the family, and the peace you worked so hard to reach. And that is sometimes the wisest move of all.